Good morning, my name is Per Wisén. I work here at the Swedish House of Finance, and I'm going to moderate this panel discussion. And we have a very distinguished panel. I will present them shortly. And the question we will be addressing is this one: can sustainability generate outperformance in public markets? And I'm going to start by asking you that question. We have, I don't know if you've seen this Mentimeter thing. If you take up your mobiles, and if you type in MENTI, menti.com, and if you enter the code 615081 on that page, you will be able to answer the question. And I'm very curious to see. We have heard some academic answers to the question, but what do you think here in the audience? Can sustainability generate outperformance? Yes, no, don't know. Yes is leading by a wide margin so far. This is like election night. 70 voters. Seems to be stopping. We seem to have a clear yes majority. 52 out of 80 thinks that it does generate outperformance. Thank you. Interesting. As I said, we have a very distinguished panel who will also take on this question. We see if they are as positive to generating outperformance as the audience. First on stage we will have Magnus Billing. Magnus is CEO of Alecta, a provider of collectively agreed occupational pensions with a large portfolio under management. And Magnus has a long distinguished career in Swedish financial markets, and those of you who work there probably know him very well. After him, Javier Aragnar, also with a long distinguished career in Swedish asset management in various positions, and who now is in charge of capital management at AMF, another Swedish pension provider. And after them, Laura Starks has promised to give us a few comments, maybe on the results we saw up there. And after that, it's sort of time for discussion. And our ambition with these conferences is to have an exchange of ideas and, between the financial community and academia. So please take the opportunity. I have prepared some questions, but if I fail to ask any of them because you have so many questions, I will consider that a success as far as I'm concerned. So please take the opportunity to either ask questions or just voice your own opinions on these matters. And we have until 12 o'clock doing this. Also, I promised to say that if any of you is a tweeter, there is a Twitter address. It just disappeared. It will probably come back if you want to use it. With those words, Magnus Billing, please, the floor is yours.
Thank you, Per. I don't have any slides, but I hope I can give some insights into these very important questions. Thank you for having me here today and giving me the opportunity to speak here today. I am the CEO of Alecta. As was mentioned, we're an occupational pension company. We manage about $90 billion. We've been around for more than 100 years. And what is great with this company, many things are great with this company, but what I think is very fascinating is that the basic idea of the company, when it was formed in 1917, is very much still valid and very much in the DNA on how we operate and how we run the business on a daily basis. And the basic idea is basically to ensure as much pension as possible for our customers at any given time. before, during, and after the work life. And we are a mutually owned company. We have 34,000 enterprises owning us. We have 2.4 million private customers owning us. So given the task that they have given us, it's it's fairly easy to focus the operation of the business. It's as much return as we can get, be extremely cost efficient, and ensure that our customers are satisfied, and ensure that they feel safe and secure from the point of view that many customers find this business very difficult to understand and feel that it's a topic which is not sort of on their radar here and now. That is something far down the road in the future, and therefore they don't want to spend time learning about the product, taking conscious decisions, but they remain passive. So around 60% of our private customers are actually passive, i.e. they come to us as a customer by default, by not choosing. And that puts a big responsibility on us and how we operate. Now, given the task we have and given the 3 goals we have what I would say a fairly unique investment model. But the basic idea of that, before I come into that, is again to generate as much return as possible over time. And I think that is what this question is lacking a little bit, the time aspect of it. Because if you put the short time horizon on the question, I think you will have a different reply maybe than if you have a time horizon that we are fortunate to have, i.e. 30, 40, 50 years down the road. It's a big difference between that. Now, I will talk a little bit on how we operate and how we try to generate return from an Alecta point of view. And I will also talk a few minutes about the privilege I had to be part of a expert group that the European Commission established, the high-level expert group, which came up with a report in January this year after 1 year's work, and that I think will have some impact on the regulation of the financial markets going forward. We see some signs of that, or some initiatives coming out from the Parliament and coming out from the European Commission right now. So those are the 2 topics I would spend 5, 6, 7 minutes on. Alecta, again, our investment model. We are what we call a active manager. We believe strongly in fundamental analysis. We have a fairly traditional portfolio, equity, real estate, interest rate products. Of the $90 billion, about 40% is into equity. What makes us a little bit unique is that on the equity side, we only invest in 100 companies, basically, 100 plus something. And we do that consciously. We believe that we need to understand these companies very well. We need to understand their business model and how they generated value over time. And we want to know that in-house. So we want to have the competence and understanding in-house. And we think that creates some value. It's a good match for our long-term view, to have a deep knowledge of the companies we invest into. And we believe that having the knowledge in-house is a very efficient way to keep the costs down. This means that we have we're fairly slow in moving. So if you look at our portfolio from a regional point of view, you will notice that we don't have any direct exposure to the emerging markets. And the reason for that is many, but one could be that we are sort of building up knowledge, and that takes some time before we can enter the market. However, if you look more deeply into our portfolio, you will notice that we have a good, solid diversification also from a regional point of view, indirectly via our holdings in the companies. I think that this model allows you to consider ESG factors in a very in a sophisticated way, because to me, in my mind, the key for any ESG investment is understanding the risk over time and having a proper long-term view on the business model that you're assessing. So if you can do that, if you can assess the business model and its sustainability over time with a proper risk definition, you're actually able to integrate ESG factors in the investment process. I'm not saying that we're there yet already, but we're moving into that direction, that the ESG factors will be integrated into an investment process. And it will be a natural tool for our portfolio managers to assess the value creation of the entity that they want to invest into. I think this is the key. And that is also the key, I think, to the way we look upon the question about outperformance, that we want to have a long-term view, given the fact that our customers expect their pensions to be paid out in 30, 40 years. And we want to therefore have a proper risk definition, basically saying that it's too narrow today. We want to have a wider risk definition, considering the risk that we can see from a transitional point of view in certain sectors, but also from a policy regulation, given the fact that we have clear ambitions from the many policymakers on what they want to do with the society going forward. On top of this, which is sort of the core investment strategy, we try to invest also in green bonds, and we do that to a large extent. But again, I want to stress that that is a key, the fundamental idea of that is, again, to generate as much return as we can for our customers. So it's not a way to deviate from that principle, but it's vetted and assessed in the same way as any other investment opportunity we have there. So for us that have invested about 30 billion Swedish into green bonds up to date, it's still with the presumption that this is generating the best return for our customers, given the risk profile of that asset. We have started some investment into so-called impact investments, still on a low level. We are finding that a little bit challenging from the point of view that does it generate the necessary return for us, and does it carry a cost efficiency? And the cost efficiency is extremely important for us. We manage the assets we have at the cost of 2 basis points right now. And it's not that easy to find large-scale investment opportunities in the impact area at that kind of cost level. It's extremely difficult. So we have a supply issue if you want to be loyal to your targets of securing return over time and being cost efficient. And I think that's a challenge for the market as such, if it's going to be successful in attracting the mainstream capital going forward. Having said that, for us, impact investment is an opportunity as any other opportunity. It's not an issue of sort of stepping away from the idea to secure return over time. On the Elekta side, I'd like to point out one last point before I go into the H-leg work, and it's the G in the ESG. To us, the G is extremely important in ensuring that we can impact, or we can have an impact on how the companies are operating from a sustainability point of view. That's sort of the entrance ticket into having a relevant discussion with the equity holdings that we have. And again, I think our model is supporting us in that respect, given the fact that we have a very long-term horizon. Many of our largest holdings in the Nordics are running for 40, 45, 50 years. And our ambition is to hold them basically for eternity, as long as we believe in the business model being sustainable over a long period of time. And that relationship that we build up over the years with the in-house knowledge and capability is extremely helpful. And it allows us to talk about aspects other than the G, the E, and the S. And it allows us to have a meaningful and constructive dialogue with the equity holdings. So I think that model, the active management model, is supporting the objectives of integrating the ESG factors into the investment process. I was then very glad to see that when the work of the expert group with the European Commission started, the discussion was very much based on Mark Carney's speech in, I think it was 2015 or so, about the tragedy of the horizon, i.e. that the market is too short term and it has a too narrow risk definition. And that was the basis of the 20 people being part of this group, that we want to see how can we prolong, or how can we make the investment horizon longer, and how can we ensure that the risk definition is the proper one, i.e. the assumption being that it's too narrow today. with the belief that if we could succeed in that, if we could take out the hurdles for allowing that to happen, the mainstream capital would be allocated to a large extent towards sustainable investment than it is today. And we know that if we're going to reach the policy decisions in Paris Agreement or what the Commission has stated out, we need to ensure that the mainstream capital is allocated more to sustainable investment than it is today. We're talking about gigantic numbers like 200 billion euros per year for the coming 12 years and so forth, well, you all know this. So that was the basis, which fitted very well into Alecta's investment model, I think. And we came up with a number of recommendations that is now being worked. Some of them are being worked with by the Commission, transforming them into legislation as we speak. One thing that I think is very important, one recommendation that I would like to bring forward is the fiduciary duty. What is the duty of an asset owner or asset manager when it comes to managing the money of a third person? What is the actual duty to that? And you had all the discussion from it's only about return. It's about other things than just generating return. I think what we were able to contribute in that context was a recommendation to create harmonization, to create clarity, basically. Because if you look at some of the research and some of the practitioners' position there, there's a diversification that is quite wide. And I think some of the pension funds in Europe, if you look at the statistics, about 20% of them are integrating ESG factors into the investment process. That's a fairly low number, given the policy ambitions of that we have out there. So, and one of the reasons that I think the number is so low is because they are concerned that it's in contradiction with the fiduciary duty to consider ESG factors into the investment process. So it was important for us to clarify that we believe that it's not in contradiction with your fiduciary duty to integrate ESG factors into your investment process. But having said that, that could take the form, it could be shaped in many different ways given who you are in the market. I mean, you could be a HFT trader. Obviously, you have a completely different view on ESG factors into your activity in the market compared to a pension fund being an asset owner and have a long-term view of 30, 40, 50 years. But you should anyway be considering the ESG factors into your operations. And you should, given the fiduciary duty, explain to your customer, if that's the asset owner or whether that's a private customer, how you are integrating that and how you're working with that topic. So you as a buyer of that service can take that into consideration when you decide who's going to supply you with that service. So that was the basic idea, customer driven. And I think we also saw the importance of clarification given the diversification in legislative initiatives from the European Commission. You have MiFID II interpreting the concept differently compared to IR 2 or Solvency II, for example. So there was a need to create a clarification there. The Commission is running with this, and I hope it will have an impact on how we are investing going forward. Final point I'd like to make on the recommendation, we have a proposal on taxonomy. I think this is a very tricky area to decide what is a green asset and what is not a green asset, what is a green activity and what's not a green activity. I noted that the European Commission picked up on our recommendation, but they want to have that as a starting point. So they want to start with defining what is a green activity, what is a green asset, and from there everything else should flow, including a supporting a green supporting capital factor, i.e. a lower capital charge for green investments. I'm very concerned about that approach. I think that's the wrong approach. I think risk should be treated as risk, nothing else. I think if you open up the Pandora box of trying to define what is green and what is brown, the likelihood of an innovative financial market being incentivized to classify as much as possible as green could jeopardize the financial stability of the market going forward. Having said that, I'm a strong supporter of taxonomy as such, but I think we need to sort of put that in the right context as such. Final point, I'm sorry, I'm running out of time. We talk a lot about governance in the H-leg report. Again, tying back to what I mentioned about Alecta, I think that's the entrance ticket. I think it's very important how we sort of drive governance as an investor, as a market participant in the market. It comes down to culture. It comes down, obviously, to incentive schemes, allowing them to be more long-term than maybe it's the general trend in the market. It comes down to the customer expectation on the time horizon for market participants to act and how you govern that. And that is maybe a point that we need to work with a lot. And I think the Alecta, we feel that that is a key thing that where we can contribute as a long-term active manager with fundamental analysis as the basis for our operation. Thank you very much.